As 2025 comes to a close, the crypto market feels suspended in a way that is difficult to describe unless you have lived through multiple cycles. Prices are not collapsing, but they are not accelerating either. Bitcoin remains historically elevated, yet well below the levels many expected by this stage of the year. Altcoins, once again, have underperformed expectations, delivering selective strength but no broad participation. The dominant emotion across the market is not fear or euphoria, but fatigue. A quiet, grinding frustration that comes from months of sideways movement and narratives that fail to translate into price. This emotional state is precisely why the coming weeks matter more than most people realize, because markets rarely turn when participants feel energized. They turn when participants feel worn down. December, for all its symbolism, is almost never the moment where market direction is decided. It is a month of avoidance, not engagement. Institutions reduce risk, protect performance, and deliberately step away from decision-making. Capital is not chasing opportunity. It is avoiding regret. Funds close their books, traders wind down exposure, and risk committees defer action. Price moves in December are often exaggerated by thin liquidity and should not be mistaken for conviction. This is why January matters so profoundly. January is when avoidance ends and responsibility returns. Capital that has been deliberately sidelined becomes inefficient. Allocations that were postponed must be revisited. Mandates are renewed. Targets are reset. And decisions that were deliberately delayed become unavoidable. This behavioral pattern is what people refer to as the January effect, and it is rooted in structural incentives rather than superstition. In traditional markets, the January effect has been studied for decades. Small-cap equities often outperform early in the year as risk appetite returns. Commodities see positioning shifts as macro expectations reset. In crypto, the effect is more extreme, not because crypto is irrational, but because it is thinner, faster, and more sensitive to flows. When capital re-enters, it shows up quickly, and when it does not, the absence is just as revealing. What makes the start of 2026 uniquely important is the context in which it arrives. This is not just another January. This is the first January in which crypto is operating fully within a post-exchange traded fund, post-regulatory clarity environment. Crypto is no longer an outsider asset class testing the boundaries of legitimacy. It is now partially integrated into traditional finance, subject to institutional scrutiny, compliance frameworks, and portfolio-level decision-making. That fundamentally changes how January behaves. In previous cycles, January strength was driven largely by retail enthusiasm returning after the holidays. Traders came back refreshed, risk appetite surged, and price responded accordingly. Institutions were present, but peripheral. In 2026, retail enthusiasm is secondary. The marginal buyer is institutional, and institutions do not behave emotionally. They behave structurally. They do not chase momentum. They allocate based on mandates, correlations, risk budgets, and long-term objectives. That makes the signals to watch this January subtler, but vastly more important. One of the most common mistakes market participants make is overinterpreting the first few trading days of January. Early January is noisy by design. Liquidity does not return evenly. Some desks come back immediately, others stagger in over days or even weeks. Algorithmic systems test liquidity and reactions. Traders probe support and resistance. Media headlines exaggerate moves that would barely register in normal conditions. This creates false starts in both directions. Sharp rallies that immediately fade. Sudden drops that recover just as quickly. Treating these moves as conclusions rather than questions is how people get shaken out of positions unnecessarily. What matters is not whether the market moves, but whether it accepts those moves. If Bitcoin pushes higher in early January and then finds support, that tells you capital is willing to stay engaged. If it rallies and fades repeatedly, that suggests hesitation. If price pulls back sharply but finds buyers quickly, that indicates demand beneath the surface. Slow, grinding declines with no response indicate indifference. These behavioral patterns reveal far more about market intent than any single headline or analyst quote. Another critical element of the January effect is selectivity. Crypto does not move as a single organism at the start of the year. Bitcoin typically moves first Because it is the most liquid, the easiest to allocate to, and the least controversial from a compliance standpoint. Altcoins behave very differently. Broad altcoin rallies early in January are rare. What usually occurs is narrow strength concentrated in assets with liquidity, regulatory clarity, or institutional narratives. Everything else either lags or never moves at all. This is where many participants misread the situation. They see a handful of altcoins rally and assume an altcoin season has begun. In reality, what is happening is risk is being tested, not embraced. Institutions do not rotate into speculative assets until they are confident in market direction and liquidity conditions. Early January is about confirmation, not expansion. Broad participation comes later, if it comes at all. Exchange-traded funds add another layer of complexity that will dominate headlines next week. Early January is rebalance season. Funds adjust weightings, realize gains, manage tax exposure, and reposition allocations. This process produces a flood of headlines about inflows and outflows that are routinely misunderstood. An outflow does not automatically mean selling pressure. It can represent profit-taking, reallocation between products, or accounting adjustments. What matters is persistence and context. Sustained outflows combined with falling prices and rising volume signal weakness. Choppy flows alongside stable prices indicate digestion and repositioning. Retail investors tend to react to the first data point they see. Institutions look for patterns over time. This difference in perspective is why January often feels chaotic to observers who lack experience. Headlines swing from bullish to bearish day by day, while the underlying structure evolves slowly beneath the surface. Understanding this distinction is essential to maintaining emotional discipline. Psychology plays an enormous role in how January unfolds. Crypto is ending 2025 in a state of exhaustion. Many participants expected fireworks that never came. Sideways movement erodes confidence more effectively than sharp declines, because it creates uncertainty rather than clarity. People become bored, skeptical, and disengaged. This matters because markets do not require optimism to move higher. They require pessimism to be wrong. Low expectations create asymmetry. When expectations are muted, even modest positive developments can trigger outsized reactions. This does not guarantee upside. It does mean the reaction function is skewed. If January delivers even slightly better outcomes than expected, sentiment can shift rapidly. If it disappoints, the timeline stretches, but the cycle does not necessarily end. Some of the strongest crypto cycles in history began with frustration, not excitement. They emerged from boredom, not euphoria. To navigate this period effectively, it is essential to avoid anchoring to single price levels. $90,000, $100,000. These numbers matter psychologically, but they are not definitive signals. What matters is how the market behaves around them. Acceptance versus rejection tells you far more than a brief touch or failure. Structure matters more than spectacle. It is equally important to resist drawing conclusions from the first few trading days of January. Early moves are almost always misleading. The first full week provides more information. The second week provides confirmation. Patience is not optional during this period. It is a requirement. Another often overlooked signal is what does not move. Assets that remain flat while others rally reveal where conviction is lacking. Silence is information. In markets, inactivity is often more telling than activity. It is also critical to understand that January does not decide the entire year. What it decides is tone. It tells you whether the market is leaning toward engagement or avoidance, whether capital is curious or cautious, whether patience is likely to be rewarded quickly or tested over time. That tonal information shapes behavior for months. Our view is straightforward. The first 2 weeks of 2026 are not about prediction. They are about observation. They are about watching how capital behaves when it no longer has an excuse to remain sidelined. They are about seeing whether crypto is treated as a core allocation, a tactical trade, or a deferred opportunity. They are about understanding whether the market is transitioning or stalling. This is not the moment for hype. It is the moment for clarity. Understanding January is how you avoid reacting emotionally to February headlines. It is how you remain grounded while narratives swing wildly. It is how you position yourself to respond thoughtfully rather than reflexively. We will be here every day, tracking flows, structure, and sentiment as liquidity returns and the market reveals its intentions. This is the part of the cycle where patience is tested, discipline is rewarded, and understanding matters more than conviction. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.